161.76. Monday opens with the dollar-yen at a price that feels invincible. Every single trend signal on your screen is screaming strong buy. And that is exactly why this is the most dangerous week of the month. Because on Friday, the Japanese government slipped a single phrase into a draft policy document, appropriate monetary policy, and that phrase is a door quietly opening for the intervention ghost to walk straight into your account. This week has one danger zone and one 3 to 5 day opportunity, and I'll show you both right now. Stay to the end. I'm giving you 2 Monday scalps engineered for the Asian London handover, and one swing trade that could run for days if the ghost doesn't appear. For the next 3 to 5 days, the structural bias is trending higher, a strong buy continuation sustained by a widening yield differential. But the trading bias is a controlled fade at a specific level, because the herd is long, the stops are tight above 162, and the intervention tail risk is mispriced. The single invalidation level that flips the entire weekly outlook is a daily close below 160.77. Write this number down. 160.77. That is the 20-day moving average. If price closes below that this week, the monthly structure resets, and we are no longer talking about a dip to buy. We are talking about a liquidation event that targets 159.50 and then 158.69. Right now, retail positioning data shows over 70% of traders are net long and institutional. Desks are holding the same direction but hedging with very short-dated volume that means the liquidity pool above 162 is extremely dense. A perfect stop-hunt zone that can either trigger a melt-up breakout or get torpedoed by a single verbal intervention headline. The week is defined by 162.00 on the upside, and 160.77 on the downside. Pull up your weekly chart. The trend is so strong that the ADX is reading 6 to 4, an extreme reading that normally precedes a volatility event, not a calm extension. The weekly candle closed at 161.76. Well above the 200-week moving average at 156.67 and above the 100-week at 158.69. The 50-week MA at 159.78 is sloping higher, and the 20-week MA at 160.77 is acting as a dynamic trampoline. Price hasn't touched the 20-week MA in over 3 weeks. This week, the mean reversion pull of that level is a silent gravity field. On the daily chart, the MACD is still printing positive histogram bars, but the signal line is flattening at 0.70. That's not a bearish divergence yet, it's a momentum plateau, which means any exhaustion candle near a psychological barrier becomes highly significant. RSI on the daily is at 71, not quite overbought but in the zone where fast money starts taking partial profits. The 60-minute chart is where Monday's game is played. MA20 on the 60-minute is at 161.56, MA60 at 161.33, MA200 at 160.84. All of them are stacked bullish. But here's what most traders won't realize until Wednesday. The 60-minute RSI is already forming a subtle bearish divergence against the Friday high, and the 4-hour chart shows a narrowing range with a CCI that's fading from overbought toward the zero line. This compression coil is building energy that will release violently, likely coinciding with the first high-impact US data print of the week. For this week, key weekly resistance levels are 162.00, the big psychological barrier and the top of a multi-decade channel, then 162.85, which is the 161.8% Fibonacci extension of the last 3-week range. Support sits at 161.30, the Friday value area high, then 160.77, the daily 20 MA, and the critical floor at 159.50, the 50-day MA. The daily triggers inside the week's range are the Asia session low around 161.50 and the London opening swing high near 161.90. Crosser set. Watch the US 10-year yield. If it breaks above 4.65% and holds, the yield differential puts a floor under US dollar to Japanese yen, drowning out intervention noise. If equities start selling off hard, the yen catches a haven bid, and that accelerates any reversal. The weekend headline is a classic slow burn fuse. The Japanese government's draft economic plan calls for appropriate monetary policy in coordination with the BOJ. That is political language for "we are watching the currency and we want options on the table." The market initially shrugged, but the phrase is now being dissected by Tokyo desks. It introduces a policy uncertainty premium that hasn't been priced in for the last 12 weeks. Combine that with end-of-quarter rebalancing flows. Japanese institutions are repatriating funds, which creates a natural yen demand against the dollar, but US fixed income flows are still sucking in global capital. The narrative web for the next 5 days is a tug-of-war between sticky US yields and Japanese verbal intervention. Tuesday is quiet, but Wednesday brings US durable goods orders and a batch of housing data. That's the fuse. Thursday is the real powder keg. Final Q1 GDP revision and weekly jobless claims. Friday closes the week with the PCE deflator, the Fed's preferred inflation gauge. A hot PCE number could launch the melt-up through 162.85, while a cold print plus a surprise BOJ comment could trigger the collapse. The 1 to 2 week directional lean is still long, but the invalidation is a daily close below 160.77. And if PCE comes in below 0.2% month-on-month, the probability of a 200 pip unwind spikes dramatically. Here's where I need you to engage. Do you think dollar-yen closes above 162.00 this Friday? Comment yes or no right now. I'm tracking the community consensus for Sunday's follow-up video. Most people skip the planning phase. They look at a chart, see green, and click buy. That's exactly where this week's money is lost. Keep watching, because I'm about to give you 3 precise, executable plans with hard levels, and if you wait for the market to tell you what to do, it will already be too late. Strategy 1. The Monday Opening Scalp. Strategy 1. The Monday Opening Scalp. Scalping, high probability. This is designed for the first 1 to 3 hours after the Frankfurt Open, when London liquidity floods the pair. The trigger condition is a clean retest of Friday's value area high at 161.30 and a bullish 5-minute reclaim. If price trades down to 161.32 and the very next 5-minute candle closes back above 161.45 with a higher low, you enter long. Stop loss goes at 161.24, just below the overnight Asian session low, giving you an 8-pip cushion. Take profit 1 is 161.75, a 1.5 to 1 reward to risk that captures the pushback into Friday's close. What instantly voids this Monday scalp is a 5-minute close below 161.25. If that happens, the Monday structure is broken, and you stand aside the Monday opening SCLP entry, 161.45, 5M candle close reclaim above 161.30 value high, stop loss, 161.24 take profit 1, 161.75 risk, reward, 1:1.5 R invalidation, void if any 5M candle closes below 161.25 strategy 2. The Monday liquidity grab, scalping, counter noise. This one exploits the hunt. The Friday high was 161.92. The Asian range this morning printed a high at 161.85. Just above that zone, between 161.95 and 162.05, there is a thick cluster of buy stops from breakout traders and a wall of sell orders from option barriers. Price is likely to spike into that zone, trigger the stops, and immediately reverse as real money fades the breakout. Your entry is a snapback confirmation, after a 5-minute candle wicks above 162.00 and then closes back below 161.90, you enter short on the candle close. Stop loss is placed at 162.12, just above the wick, giving you a tight 12 pip risk. Your target is the nearest liquidity pool, 161.60, which is the midpoint of Friday's range and today's Asian volume-weighted average price. This is an aggressive counter-trend scalp, so execution must be instant. If the candle closes above 162.10, the grab has failed and you do not chase the Monday liquidity GRAB entry, 161.88, 5M candle closed back below 161.90 after a 162.00 plus wick, stop loss. 162.12 take profit 1. 161.60 risk, reward. 1:1.2 are invalidation. Void if 5M candle closes above 162.10 after strategy 2, I need you to commit. Are you scalping Monday or swinging the week? Comment scalp or swing below. Let's see who's built for this market, because the swing trade I'm about to give you requires a very different heartbeat. Strategy 3, the 3 to 5 day swing, trend alignment. This is the trade designed to capture the core yield differential move, if and only if the intervention ghost stays in the grave. The trigger condition is a daily close above 162.00. Not a wick, not a 4-hour flirt. A New York close above that barrier on the daily chart signals the melt-up is real and momentum funds will chase into the end of the quarter. Entry is at the daily close print. You set a stop entry order at 162.05 for the next day's open. Stop loss is placed at 160.70, below the 20-day MA at 160.77, giving you a structural invalidation. That's a 135 pip stop. Take profit 1 is 163.50, the next major resistance level from multi-year highs, giving a 145 pip gain. Take profit 2 is the stretch target at 164.80, the upper boundary of the long-term channel, for a 275 pip reward. The risk to reward on the first target is 1-to-1 roughly, but trailing to the second target pushes it above 1-to-2. Once price reaches 162.80, halfway to TP1, move your stop loss to break-even, 162.05. The explicit invalidation that would negate the entire weekly outlook is a daily close below 160.70. If that prints, the swing is dead, and you exit immediately to 3 to 5 days of NG entry. 162.05, daily close above 162.00, entry on next daily open, stop loss. 160.70 take profit 1. 163.50 take profit 2. 164.80 risk, reward. 1:1.0 R to TP1, 1:2.0 R to TP2 trailing stop. Move SL to break-even, 162.05. When price hits 162.80 invalidation, void if daily close below 160.70 never risk more than 1% of your account on the scalps, and 2% max on the swing. Holding through Thursday and Friday with the PCE data requires you to either reduce size or widen stops to account for the volatility spike. Stops are non-negotiable. The intervention ghost is real, and a single news headline can gap through levels. Surviving that is what lets you trade the next big weekly move. 1 level matters above all others this week, 162.00. A daily close above it, and we are staring at a melt-up that could reach 164.80 by Friday. A rejection there, especially with an intervention headline, and the floor drops to 160.77, then 159.50. If that 159.50 level breaks on Friday, the whole monthly trend flips, and I will have the updated blueprint for you this Sunday. If you missed last week's recap where we caught the 160 breakout before it ran 100 pips, that video is live now. Tap the end screen, and you'll see exactly how the levels we discussed played out. Then hit the bell so Sunday's next week ahead alert lands before the open and you're never behind the institutions again. Hold the like button and subscribe. Every signal helps the algorithm bring you the levels that define your week. This week is ruled by 162.00. I'll see you in the next one, but only if you're still in the game.